Ever wondered which growth-focused ETF could maximize your investment returns? Today, we're diving into the world of exchange-traded funds, or ETFs, shining a spotlight on two giants, SCHG and QQQ. Both aim to provide robust exposure to large-cap growth stocks, but they do so through different indices. As investors seek out the most promising avenues for growth, understanding these ETFs' performance metrics becomes crucial. Join us as we dissect the numbers and uncover potential investment opportunities. Plus, there are some key takeaways at the end to consider to make the gains a possible reality for you. Imagine starting with an investment of $10,000. How did SCHG and QQQ fare over the years? Let's delve into the journey of these two growth-focused ETFs. Both started with the same initial investment, but their paths and outcomes diverged significantly over time. SCHG, the Schwab U.S. Large Cap Growth ETF, took this $10,000 and, through various market conditions, grew it to $39,404. Impressive? Absolutely. But let's compare it to QQQ, the Invesco QQQ Trust, which operates in a similar domain but with a different strategy and index tracking. QQQ turned the same initial $10,000 into a striking $46,960. This remarkable growth by QQQ not only highlights its strong performance, but also underscores a higher growth rate compared to SCHG during the same period. It's clear, QQQ provided a heftier return on the initial investment. But what about the annual growth? Annual returns can tell us a lot about the consistency and strength of an investment. Diving into the world of growth-focused ETFs, we observe the compound annual growth rates of SCHG and QQQ. Here, QQQ emerges with an annualized return of 17.85%, outstripping SCHG's 15.68%. This difference might seem slight at first glance, but in the realm of investment, every fraction counts. To put this into perspective, imagine the effect of these returns over the long haul. The higher annual return of QQQ not only suggests a robust growth trajectory, but also indicates a potentially greater compounding effect over time. QQQ has an expense ratio of 0.2%, while SCHG has an expense ratio of 0.04%, making it less expensive. Thus, while both ETFs offer promising avenues for growth, QQQ's superior annual performance might make it a more attractive option for those prioritizing higher yearly gains. With QQQ leading in yearly growth, it's tempting to lean towards it. But how do these ETFs handle market volatility? Higher returns often come with higher risks. Let's see if that's the case here. When delving into the realm of investments, particularly with ETFs like SCHG and QQQ, understanding volatility is crucial. Volatility, quantified by standard deviation, indicates how much an investment's returns can vary from its average return. For SCHG, the standard deviation sits at 17.92%, suggesting a moderately volatile behavior. On the other hand, QQQ records a standard deviation of 18.95%, pointing to slightly higher volatility. This higher volatility in QQQ correlates with its ability to reach loftier peaks, but also to dip into deeper valleys. For instance, the worst year performance for QQQ was a loss of 32.58%, just nudging past SCHG's worst dip of 31.80%. This marginal difference underscores a vital aspect. With greater potential returns comes a slightly increased exposure to risk. QQQ rides higher but swings wider. Now let's consider how each ETF compensates for these risks. Returns are just part of the story. How efficiently do SCHG and QQQ manage risks? When assessing investments, savvy investors often look beyond mere returns to understand how those returns were achieved. Enter the Sharpe and Sortino ratios, two critical metrics that gauge the risk-adjusted performance of investments. The Sharpe ratio, which measures the average return earned in excess of the risk-free rate per unit of volatility, stands at 0.82 for SCHG and 0.89 for QQQ. This indicates that for every unit of risk taken, QQQ provides a higher return compared to SCHG. Moving on, the Sortino ratio, which focuses only on undesirable volatility, tells a similar story. SCHG's Sortino ratio is 1.33, while QQQ leads with 1.47. This suggests that QQQ not only yields higher returns, but does so with a better handling of downward price movements, making it more efficient in terms of managing bad risks. QQQ not only grows faster but also manages risks more adeptly. Let's wrap up and see which ETF might suit your investment profile. We've journeyed through the numbers and performances. It's decision time. In the realm of growth-focused ETFs, the comparison between SCHG and QQQ has illuminated some clear distinctions. QQQ not only surpasses SCHG with a remarkable end balance of $46,960 from a $10,000 start, but it also leads with a higher annualized return of 17.85%. This positions QQQ as the more robust performer in terms of overall growth and yearly gains. However, this superior performance doesn't come without its share of volatility. QQQ exhibits a slightly higher standard deviation at 18.95%, indicating more frequent and larger swings in investment value. When it comes to navigating these financial waters, the Sharpe and Sortino ratios offer a beacon. QQQ's Sharpe ratio of 0.89 and Sortino ratio of 1.47 both outshine SCHG's metrics, suggesting that QQQ provides better returns per unit of risk taken, especially in downward market movements. If you're looking for a cheaper alternative to QQQ, then FTSE or VGT with expensive ratios of 0.08 and 0.1% could do the job for you. And remember, the largest returns come from two factors: time in the market and amount invested in the market. So the more you invest consistently over time and hold on to for longer, the bigger your financial returns can turn into. Subscribe for more, and also comment on what fund you would like me to look into next.